Well, now I'm going to talk about the benefits of blockchain in finance. For them, I'm going to answer the question: what are the benefits of blockchain in finance? The Ethereum blockchain enables more open, inclusive, and secure business networks, are operating models, more efficient processes, reduced costs, and new products and services in banking and finance. It enables digital securities to be used within shorter periods of time at lower unit costs with greater levels of customization. Digital financial instruments may thus be tailored to investor demands, expanding the market for investors, decreasing costs for issuers, and reducing counterparty risk. Over the last 5 years, the technology has matured for enterprise grade use, demonstrating the following benefits. Security. Its distributed consensus-based architecture eliminates single point of failure and reduces the need for data intermediaries such as transfer agents, messaging system operations, and inefficient monopolistic utilities. Ethereum also enables implementation of secure application code designed to be tamper-proof against fraud and malicious third parties, making it virtually impossible to hack or manipulate. Transparency. It employs mutualized standards, protocols, and shared processes, acting as a single shared source of trust for network participants. Trust. It's transparent and immutable. Ledger makers makes it easy for different parties in a business's network to collaborate, manage data, and reach agreements. Programmability. It supports the creation and execution of smart contracts, tamper-proof deterministic software by automates business logic, creating increased trust and inefficiency. Privacy. It provides market-leading tools for granular data privacy across every layer of the software stack, allowing selective sharing of data in businesses networks. This dramatically improves transparency, trust, and efficiency while maintaining privacy and confidentiality. High performance. Its provide and hybrid networks are engineered to sustain hundreds of transactions per second and periodic surges in network activity. Scalability. It supports interoperability between private and public chains, offering each enterprise solution the global reach, tremendous silences, and high integrate of the mainnet. According to a report by Jupiter Research, blockchain deployment will enable banks to realize savings on cross-border settlement transactions of up to $27 billion by the end of 2030, reducing creating over 10 times cost advantage against incumbent technologies. Financial institutions acknowledge that distributed ledger technology will save billions of dollars for banks and major financial institutions over the next decade. How does the digitalization of financial instruments impact finance? The digitalization of financial instruments comprising digital assets, smart contracts, and programmable money takes the benefits of blockchain further by forging unprecedented levels of connectivity and programmability between products, services, assets, and holdings. These digitalized instruments will redefine the processes of commercial and financial markets, creating a new paradigm where value is brought at every touch point. Digital financial instruments offer the following business benefits: authenticity and scarcity. Digitalization ensures data integrity and enables asset provenance and full transaction history in a single shared source of truth. Programmable capabilities. Code that addresses governance, compliance, data privacy, identify KYC, AML attributes, system incentives, and features that manage stakeholder participation for voting and other rights can be built into the assets themselves. Streamlined processes. Heightened automation increases overall operation efficiency. It enables real-time settlement, audit, and reporting, and it reduces processing times, the potential for error and delay, and the number of steps and intermediaries required to achieve the same levels of confidence in traditional processes. Economic benefits. Automated, more efficient processes trigger reduced infrastructure costs, operation costs, and transaction costs. Market reactivity. Digital securities allow greater customization than standardized securities and can be used within shorter time frames. Users can create bespoke digital financial instruments directly matched to investors' demand. New products and markets. Secure, scalable, and rapid asset transfers, fractionalized ownership of real-world assets, tokenized microeconomies, and more. Together, these benefits result in more accountable, transparent governance systems, more efficient business models, improved incentives, alignment between stakeholders, greater liquidity, lower costs of capital, reduced counterparty risk, access to a broader investor and capital base, and access to all their all other digital financial instruments. What are the blockchain use cases in financial services? Capital markets, insurances, sales and trading, clearing and settlement, post-trade services and infrastructure, asset servicing, custody, asset management, fund launch, cap table management, transfer agency in asset management, fund administration, payments and remittances, domestic retail payments, domestic wholesale and security settlement, cross-border payments, tokenized fiat, stablecoins and cryptocurrency, banking and lending, credit prediction and credit scoring, loan syndication, underwriting, and disbursement, asset collateralizations, trade finance, letters of credit and bill of lading, finance structures, insurance, claim processing and disbursement, parameterized contracts, reference markets. How does blockchain impact capital markets? Capital markets refers to the pairing of issuers with demand for capital to investors with corresponding risk and return profiles. Whether issuers, the entrepreneurs, startups, or large organizations, the process of raising capital can be challenging. Firms face increasingly stringent regulations, longer time to get to market, volatility from interest rates, and liquid risk. Particularly in emerging markets, they must negative navigate the lock of rigorous monitoring, stretch regulation, and sufficient market infrastructure for using. Settlement, clearing, and trading. Blockchain offers multiple benefits for several capital market use cases. Elimination of a single point of failure through decentralized utilities. Facilitation of capital market activities, streamlining process, reducing cost and decreasing settlement times. Digitalization of processes and workflows, reducing operational risks of fraud, human error, and overall counterparty risk. Digitalization, digitalization or tokenization of assets and financial instruments, making them programmable and much easier to manage and trade in token form. They gain wider market access through increased connectivity and the possibility of fractionalized ownership. This results and increased liquid and decreased of capital. How does blockchain impact asset management? Venture capital firms, private equity firms, real estate funds, and specialty markets are facing demands to provide liability risk management, adapt more dynamic decision-making structures, and address the increasing complexity of ever-changing regulation. Blockchain can effectively streamline asset and stakeholder management. It allows automated fund launch, seamless stakeholder engagement with digitized assets and services, digitization of portfolio and existing holdings for wider market access, liquidity, and fractionalization, customizable built-in private settings for transaction confidentially, voting and other stakeholder rights and obligations programmed into digital assets, resulting in seamless user experience and reduces risk of human error. Creator, creation and informants of incentive mechanisms to promote participation and punish nefarious activity. Improved governance and transparency for investors and stakeholders. Inefficient cap table management, automated fund administration, automated transfer agency, and in-asset management. How does blockchain impact global payments and remittances? Global payments and remittances today are executed by a number of intermediaries. The exact tools for their services. It takes 2 to 7 days and costs a global average of 6.94% to send $200 between countries. This means that remittances are directly reduced by $48 billion through fees, intermediaries, and financial institutions. Blockchain can streamline payment and remittance processes, reducing settlement times and significantly reducing costs. It allows rapid and secure domestic retail payments, rapid and secure domestic wholesale and securities settlement, rapid and secure cross-border payments, real-time gross settlement between central banks, commercial banks, and independent banks, digitized KYC, AML, data transaction history, reducing risks of fraud and enabling real-time authentication, automated regulatory oversight and auditing, multiple forms of payment enabled of blockchain, tokenized fiat, stablecoin, and cryptocurrency. How does blockchain impact banking and lending? Core banking comprises of transaction loan, mortgage, and payment services. Many of these services depend on legacy processes of execution. For example, between information verification, credit scoring, loan processing, and distribution of funds, it takes 30 to 60 days for individuals to secure a mortgage and 60 to 90 days for small or medium enterprises to secure a business loan. Blockchain can streamline banking and lending services, reducing counterparty risk and decreasing issuance and settlement times. It allows authenticate documentation and KYC AML data, reducing operational risk and enabling real-time verification of financial documents, streamlined credit prediction and credit scoring markets, instantaneously informed by the collocation of users, activity, and sensational data across a network. Automated syndicate formation, underwriting, and disbursement of funds, principal and interest payment, reducing cost, delay, and friction of syndication. Facilitated collaborations of assets because digitizations enables real-time asset management, tracking, and enforcement of regulatory controls. How does blockchain impact trade finance? Trade finance refers to the infrastructure, process, and funding that support international trade supply chains. The industry continues to rely on paper-based processes that are susceptible to security vulnerabilities. Individual transactions can take as long as 90 to 120 days in order to process letter of credit, verify documents, and establish trust among stakeholders. Blockchain can digitize the entire trade finance life cycle and increase it security and efficiency. It can enable more transparent governance, decreased processing times, lower capital requirement, and reduced risk of fraud, human error, and overall counterparty risk it allows. Digitalized and automated documentation, letters of credit and bill of lading, and KYC AML data with real-time verification of financial documents. Asset digitalization to enable faster settlement times, creation of more efficient financing structures through shared secure networks and digitalization processes, creation of a consistent finance bicycle for the entire trade life cycle, eliminating the legacy practice of negotiation, independent finance vehicle for each stage of the trade. How does blockchain impact insurance, property, and casualty? Insurance claims are prone to fraud, and claim assessment can extend long periods of time. Blockchain can securely streamline data verification, claim processing, and distribution, reducing processing time significantly. It allows authenticate documentation and KYC AML data, reducing the risk of fraud and facilitating claim assessments. Automatic claim processing with the use of smart contracts. Automated parameterized contracts to pay out upon occurrence of certain risk. Automated disbursement of insurance payment. Tokenized reinsurance markets to facilitate policy reinsurance in open marketplaces, stepping away from traditional broker and relationship-based system.